As political theater plays out in Washington, stocks have quietly drifted lower. Standard & Poor's 500 stock index is off 2.5% from its all-time high reached in September. But there could be reason for a few rays of sunshine amidst the clouds. Lawmakers are moving towards compromising on a broader deficit reduction in the midst of raising the debt ceiling and reopening the government. Meanwhile, the president officially nominated Janet Yellen, current vice chair of the Federal Reserve, to chair the central bank. Yellen, if confirmed, will offer continuity for the central bank's bond buying program. Still, third quarter earnings season is causing some to question whether the market has become too pricey. Here to weigh in with their outlooks for the economy, the stock market, and where to invest now are Rex Macey, Chief Investment Officer for Wilmington Trust, which oversees $78 billion. Jeff SICA, Founder and Chief Investment Officer of SICA Wealth Management, with over $1 billion in assets under management, and Todd Schoenberger, Managing Partner and Portfolio Manager for LandColt Capital. And no, if you're wondering, Todd and I are not related. Gentlemen, welcome. Great to see everybody.
Thank you.
Todd, let me go ahead and kick things off with you. The argument I kept hearing earlier this year was that growth is expected to pick up in the second half of the year, but that looks to be falling short, right? The Fed certainly lowered its outlook for the economy. You've got the shutdown, a lot of political wrangling in Washington. What's your outlook for the economy?
That's right, Jennifer. Look, you're seeing a 2.5% GDP rate right now. In the past earnings period, we saw S&P earnings growth of only 1.3%. In the first quarter, it was 3%. Yet alone, historically, we averaged 7%. So going forward into the fourth quarter, there are a lot of headwinds right now. But I got to tell you, I think the winner out of all of this is going to be the investor, only because, like you mentioned at the top, with Janet Yellen taking the reins as far as head of the Fed, she may actually continue with the current monetary policy program that we see right now with quantitative easing, which, as you know, has been excellent for stocks and should be great for investors. But it does remain to be seen, though.
Rex, how much damage has the shutdown, really congressional wrangling in general, cost our economy?
Well, so far it's brief. You know, if they resolve this quickly, it'll be minor. We'll hardly remember this a year from now. If it goes on too long, it could be severe. I mean, the real question is what's going to happen to investor confidence, consumer confidence, and the confidence of business owners who are making investments.
I'm glad you brought up confidence. Jeff, have lawmakers already done further damage to psychology at this point, right? Consumer confidence, business confidence is falling. Executives have been holding back on hiring, investing in property, plant, and equipment. Is this another dent to confidence?
I think confidence has been essentially shattered when it comes to the general public, and when it comes to politicians developing strategies that actually do anything to improve the economy. It's becoming very obvious that we've taken this position that the inmates are running the asylum, that things are not getting any better, that despite what Todd had said in terms of the Fed coming to the rescue again, what we have to realize is there's so much dysfunction now that there's nothing that the Fed could do to make this any better.
There's nothing the Fed can do to make this any better. You think we're in recession now and headed for stagflation. Is that correct, Jeff?
Yeah, I think we've been in recession. I think the biggest lie that we've been told up to this point is that we've actually seen an economic recovery. We have not seen an economic recovery. We haven't seen anything that's even closely resembled an economic recovery. What we have seen has been a lot of rhetoric over an economic recovery. When you see job growth, that the vast majority of jobs being created are part-time jobs, there has to be some indication that this has all been one big farce.
Rex, how do you respond to Jeff's claim that we are in recession now? I mean, you look at the economic data, yes, it's weak, but does it signify that this economy is contracting now?
Well, I'm just wondering, we're talking about the United States, where we have higher GDP than we've ever had before. You know, auto is recovering. Housing
never had before in terms of the 4-year recovery, you mean, Rex?
Yes, we are seeing an improving economy. That's what I call a recovery. So, and I don't think we're in a recession. We're not in, at least at this point, in a contractionary state. So I don't see the data suggesting that we're in a recession.
Todd, it seems that the Republicans in Congress are starting to offer, shall we say, an olive twig, not an olive branch, right? They're offering to raise the debt ceiling for about 6 weeks in return for the Democrats and the president sitting down with them to discuss broader deficit reduction. Does this make you optimistic? Is this a sign that perhaps we could get some tax reform, some much needed deficit reduction that could create some clarity that businesses have been looking for?
Absolutely not. Look, this takes us out to Thanksgiving weekend, and I suppose that nothing motivates people in Congress more than having to tell them they have to work through recess. But we're looking at this, though, that's definitely not a positive. If anything, it actually hits on sentiment, because remember, you're going into that peak retail holiday shopping season. The consumer, you've already seen some of these sentiment readings that are actually poor. They're very weak, and they continue to drop. And here we're going to go through the next 6 weeks with more of this arguing back and forth. So you can only suspect that for the American consumer, it's going to hurt them and also that household balance sheet. But then look at the corporate side, too. What kind of a business is going to go out and actually increase their payrolls going into the end of this year and first quarter of next year? So to go back to what Jeff is saying, and I agree with him, things are actually very weak right now, and the headwinds are there to actually make us more challenged going into not only the end of this year, but also into 2014. However, I think that's why you need the Fed involved.
Yeah, so given what your outlook for the economy, what does that spell for a potential timeline for a taper?
The taper, that's a dream. It was great that we discussed it a few months ago, but there's no shot of that happening right now. Look, you have Janet Yellen that's going in there. She's notorious to agree with Ben Bernanke. This is going to continue into 2014. The economy is in a slowdown mode. Are we in a recession? I don't know. That remains to be seen. However, you still need the Fed involved with their quantitative easing program. Whether you like it or not, it's here to stay.
Rex, what's your sense of a potential timeline for a taper? Certainly before Janet Yellen got the nod, we had different Fed governors, notably New York Fed Governor Dudley, come out and say that the Fed probably won't have the data necessary to begin tapering sometime later this year. Does that imply no taper perhaps until sometime in 2014?
I think it does. Given the uncertainty and the way the data is turning, I don't see why they would want to start a taper right now if they haven't already done so. So I think we're starting to look into 2014 before we see signs of taper. I think the bigger question is, what is their message going to be and what is the rate of taper? I think they were very surprised at how markets reacted to just the thought and the discussion of tapering, where interest rates moved up so much. They want to be a little more nuanced, I think, the next time around. They don't want to see as dramatic a turn of prices in the bond market.
Jeff, it feels like we're living in Groundhog Day, right? Rewind the clock back to 2009. How many times has the Fed tried to set the stage to begin unwinding its bond purchases, only for the economy to fall short and then have to initiate a new round of quantitative easing or some sort of variation on the program, right? Like Operation Twist. My question is QE a trap?
It is definitely a trap. And I have to tell you, I mean, I view QE as the ultimate act of desperation. Here we are printing massive amounts of money, exponentially growing our deficit. The whatever so-called economic improvement that we've gotten as a result of this has been so anemic, it's hardly worth the liability, the potential slowdown we're going to see in the economy from carrying this amount of debt. So now we're in a position where Rex said, the minute they start to begin to taper, the market sells off. The market has become psychologically addicted to quantitative easing and the fear of the unknown, that if the Fed does, in fact, pull this lifeline, what is going to happen to the market? I was one of the people who did not believe that they would taper. I felt that that there was this overwhelming concern in the Fed that asset prices have become inflated as a result of quantitative easing. They didn't want to necessarily admit that because that would initiate panic. They opted not to taper. I don't believe tapering's on the table. I think they're going to continue in this act of desperation for as long as it takes, with just this false expectation that one day investors are going to wake up and they're going to say, hey, you know what? Maybe we don't need quantitative easing. Maybe the economy is good enough.
Todd, let me go to you. One of the reasons the Fed decided to stand pat on the taper in September was because we had seen a swift increase in interest rates and borrowing costs had shot up, and they were concerned that would be an impediment to growth. Certainly, we did see mortgage activity fall off. But given that we did see the yield on the 10-year Treasury come down from close to, it was bumping up against 3%. Now it's about 2.6% and change. Will that create some relief for the economy?
I'm not so sure, because remember, you still have the criteria that's needed to actually go out and borrow. And right now, banks really don't have a vested interest in lending. I mean, no bank out there wants to go hand in hand back to the U.S. government and actually say, okay, we've loaned, we've given out money to small businesses and to individuals, but everybody's defaulting, so therefore we need a bailout. It's just not going to be seen very well. Plus, banks, from a profitability standpoint, it doesn't make a lot of sense to assume the risk, because they're just not going to make a lot of money off of those loans. But remember one thing, Jennifer, with quantitative easing and with tapering, that really has very little to do with interest rates. Now, we did see that 10-year yield, like you mentioned, bump up with 3%, and now it's at 2.6, 2.7 right now. But realistically, quantitative easing doesn't influence interest rates, I think, as many would suspect. So that's just one of those myths that continue to be out there on Wall Street.
But certainly the longer end of the curve, no, Todd? I mean, you don't think it's put a little bit more pressure on the longer end?
No, I wouldn't say so. I mean, look, if you can talk about the weaker dollar, you can get into that a little bit. We can also look at possible inflationary concerns. You know, the one thing with quantitative easing that your viewers should know, there really was a two-part approach to this. The idea is to increase that wealth effect, like Jeff was talking about, and therefore you increase demand for companies to actually go out and hire. Well, we saw an increase of demand from consumers. I mean, you remember when QE1 was first announced in November 2008, Black Friday, people were selling the sofa to go out and buy a big screen, but companies did not hire, and that remains to be stuck in quicksand. So the question remains, there really isn't any specific number right now that the Fed can continue to do, because the labor market continues to just be stuck right now.
Right. Rex, what's your outlook for the yield on the 10-year Treasury, especially given the shenanigans in Washington?
Well, in the long run, we think it's got nowhere to go but up. I mean, we are going to eventually recover. We'll have higher growth, and things will return to normal, and we'll have higher interest rates. I think.
Go ahead, Todd.
Well, when is it going to return to normal? I mean, you have $3.7 trillion in 4 programs. You figure QEs 1, 2, and 3, and the Operation Twist. You had a stimulus checks that were written by the White House, and here you still have a gross domestic product of 2.5%. What else do you need? I mean, look, if it wasn't for the Fed, you probably would be, these will be times that
we're having people argue the Fed this QE has no impact, and now it does have an impact. You can't have it both ways. The fact is we have a very anemic economy, but it is improving. It is going to be a long road, and it's going to take some time, but it is going to get better, and rates will be moving up.
All right.
I can remember that 10-year was at 1.4.
Rex, I only have 50 years left to live, so hopefully this recovery starts happening pretty soon, because I don't think I'm ever going to see it.
Well, you have a job.
All right, Jeff, let me bring Jeff into the conversation here, because we're talking about yields here. We're talking about the ability of the Fed to control the bond market. If Janet Yellen is confirmed, as many folks believe she will be, how confident are you in her ability to control volatility in the bond market?
Well, see, that's the overall problem. What this whole program is designed to do, or theorized to do, is control behavior. You know, when Queen Janet is ordained, she's going to have to come out and figure out how she could control the masses. Unfortunately, this is still America. This is still a free country, and she's not going to be able to control the behavior of investors everywhere. And when Rex talks about the economic recovery, yeah, we want to think that over time things are going to get better. But if we don't have job growth, if we don't have savings growth, if we don't have a level of confidence in the future based on knowing that the politicians we've elected to office at least could get out of the way and let the free economy reign, we have to really question whether whether there is going to be a recovery under these circumstances.
Todd, to Jeff's point on politics, so long as there is dysfunction in Washington, really political gridlock, will this economy be held back?
Absolutely. Look, it's not just political gridlock. You have overregulation. We're overtaxed as it is. And then this whole sentiment thing, you know, the whole idea that as an entrepreneur, you actually are a nervous Nelly to go out and actually do anything. Remember, if you are fortunate, let's talk about the guy who tries to open up the corner Exxon Mobil store. If this guy's lucky enough to actually get a bank loan, do you think he's actually going to go out and hire anybody? Because remember, the money he's making is passed on as ordinary income to himself. But if he has higher taxes, that's somebody's salary right now. So we're way overtaxed, overburdened on the regulation side. Has nothing to do with the gridlock, but the gridlock just doesn't help either.
All right, we got to move on. We got to talk about earnings. Rex, given, shall we say, a less than stellar economy, does that spell weaker sales and earnings in the second half of the year?
Well, I think it does affect the rate of growth. I think the fourth quarter is going to be better than the third quarter. But really what's going to drive the market with respect to earnings is the guidance people give for the future. And I think we're really starting to look at what we're hearing about 2014 at this point.
Right, it has become a bit of a game, hasn't it, Rex? I mean, at what point does the quality of earnings matter for the market? Is it when the Fed finally moves out at some point, you know, who knows when down the road? Because companies have surely exhausted their bag of tricks. They've cut costs, they've bought back shares of stock. If the economy continues to trend around 2.5%, how are they going to get revenues up?
Right. Well, and some of it's going to depend on what happens overseas. Yeah, it would be very helpful if we could see some international markets start to recover, because it's somewhat like a fire. The more wood you have burning, the hotter it gets, and that would be helpful. So as long as we've got problems in Europe as well, that is going to be to affect us. So we're looking, I think you got to look globally at seeing what's happening. But we're seeing, I think we have some positive things going out as you look into 2014, 2015 with household formation. It is not as grim as the other panelists make out.
Jeff, what's your sense for third quarter earnings?
Well, it's amazing that we're even talking about earnings, because it seems like earnings have become such a ignored topic. Everybody wants to talk about the Fed, because when the Fed's printing money, well, who cares about earnings? What I see right now is, first of all, we've had a flat line when it comes to revenue. Earnings per share have been so heavily navigated, they've been so geared towards low borrowing costs, that we have to look at revenue numbers, and revenue numbers have been continually on the decline. Expectations have been continually declining, and so much of this is contingent on low borrowing costs. If we begin to see those borrowing costs rise, we're going to begin to see some severe pressure being put on stock.
Well, we already did see borrowing costs rise, right, in the third quarter.
Not significantly. I mean significantly to a point, but not to the point that it's been reflected in earnings, at least so far. We will see the effects in fourth quarter, first quarter next year, but we haven't seen anything significant. You got to really look at revenue.
Right. Well, Todd, what about the antics in Washington? Is that also going to weigh on fourth quarter earnings?
That's right, because remember, every quarter there's always an excuse by these S&P 500 CEOs. What we always hear, maybe it's the weather, geopolitical issues. Now it's going to be about the shutdown. Look, I say we don't call it earnings, we call it losses, because here's the thing. Going forward, guys, you can cut, it's at the expense of human capital. You can continue to cut expenses and improve the earnings per share number. But that top line revenue growth continues to go lower. We saw with the JP Morgan earnings.
Well, that goes right back to my point about the quality of earnings, right?
They're awful. Look, you can lower that bar all you want, but earnings just are not as critical as they once were. Going back to what Jeff said, you know, realistically, fundamental analysis has been thrown out the window only because this is a headline-driven market. We focus on the Fed right now, but earnings season alone is a proxy for a slowing economy, and it's going to get awful this quarter, and therefore that obviously springboards into 2014 for more slowness.
So then, Jeff, if earnings don't really matter for the market, what does that mean for valuations, and how does that tie into your outlook for the stock market for the rest of the year?
Well, I'm spending a lot of time looking at the amount of cost cut, because when you get to the end of the cost cutting, you have no other way to hide. So as long as there's no other way to hide, we're going to begin to see this continued earnings erosion. And to me, if it's as simple as this: if a company's doing well, they hire people. If they hire people, the economy does better. The fact that companies, hardly a day goes by where we don't have a major company laying off people.
But Jeff, what's your outlook for the stock market?
I think we've gotten way ahead of ourselves at this point in terms of the stock market. I anticipate that there's only so much the Fed could do to keep this stability. It's been relatively calm, even in terms of the declines we've had the past few days. I see a decline of anywhere between 10 and 20% somewhere at the early first quarter. I think it's going to be we're going to play this. We're going to have a relief rally as a result of whatever quick fix solution they offer. But I think once we get back to the reality of where we are as an economy and where the market is and where corporate earnings are, we will sell off.
All right, so Jeff is expecting a 10 to 20% correction either sometime in the fourth quarter or first quarter. Todd, you're bullish on the market, though. Do you think that if politicians are able to come together, we've got Janet Yellen, who's very dovish, likely to be the next Fed chair, does that spell a nice rally into the rest of the year?
Well, it does in 2014. Remember, she's not in charge yet. So in the fourth quarter, I believe we do have a lot of headwinds right now.
But the market is a discount mechanism.
Well, perhaps. However, with that said, I think Santa Claus has already shown up to town, because I think we already had the rally that we already should have expected.
And then some.
Well, these are the highs in the markets, though. Realistically, I mean, you still have a few cult stocks out there. I mean, you have the LinkedIns, the Facebooks, the Yelps. They continue to do well. However, if you're looking at that discount, you should wait on the sidelines, at least after Washington gets its act together, and maybe you could buy some stocks at a discount. But 2014 should be a decent year only because of intervention from the Fed.
Rex, Carl Icahn and Warren Buffett seem to think that the market is fairly valued. Where do you stand on valuations now, and what does that spell for your outlook for the market for the rest of this quarter?
Well, valuation can take two forms, as I think of it: an absolute value and a relative value. Let's start with the relative value. Would I rather have my money in stocks or bonds? And in that comparison, I will take stocks all day long, particularly if we're talking about U.S. Treasuries and other investment-grade bonds. If we talk about cash, investors are very reluctant to park their money in cash where they're watching inflation erode their wealth at 2% a year. So on a relative basis, stocks look pretty good. On an absolute basis, we expect a decent single-digit positive rate of return over time. It's not the greatest. It's not the 10% people would like to think about every year. So on an absolute basis, it's not as attractive as people used to think equities are being, but it's a reasonable valuation.
So then, Rex, what are you doing now? I mean, are you keeping some powder dry? Did you use the slight sell-off that we saw in order to get back into the market? And where are you putting money to work now?
Well, we do favor equities, if you will, at the expense of core bonds, but we've also moved into and have been in higher yielding bonds, both floating rate notes at times, as well as high yield corporates. Because again, unlike some of the others, we do not see defaults picking up. Defaults have been low. It's a recovery. There is a put option by the central bank. So we like having our money in those areas.
Todd, given that you don't think tapering is going to occur for some time to come, coupled with what's really a weak economy, perhaps some political spats here and there, do you stay defensive or do you go cyclical, or perhaps look for yield, right, if the Fed's going to remain in place?
Well, look, I mean, I think you can look at any of the multinationals. I mean, look at some of the brand names that are out there. Look, I completely agree with Jeff. I think this economy is hitting a brick wall. There are diminishing returns with continued QE. But without QE, and plus, let's face facts, guys, there's no other place to put your money right now. I mean, you can focus on some key areas. I love oil, obviously. However, I'm a bear on real estate. I think investors, your viewers, will be much more, defensive, if you will, like you said, if they look for some long, short alternative investments. Those usually will be the ones that would do well this time of the year.
Give me some names quickly, Todd. Who do you like here?
Well, look, ExxonMobil is always going to be a big one. Any of the big three oil names, Chevron, Conoco, I'm a big fan of. I think you can also look at some of the companies like a McDonald's, a Coca-Cola. I love the growth story of Coca-Cola. A lot of people think it's just more, it's just a U.S. story. It's definitely not. It's an emerging market story. So those are some key names for your viewers right now to focus on.
Jeff, I have in my notes here that you're looking to avoid investing in the S&P 500. What exactly do you mean by that? Are you avoiding stocks altogether? Are you avoiding indexing? How are you investing now?
Well, I have a little bit of exposure with the S&P 500, mostly on the long-short and long-short strategies. Let's face the facts. The S&P 500 asset prices in general have been greatly distorted. So when you're trying to make an investment decision, and I know Todd and Rex are talking about, choosing investments based on the philosophy that this one is better than this one. I think when it comes down to it, and you have this much artificial inflation and asset prices, trying to select the best of the worst is not always the best thing. I'm avoiding anything that will appreciate based solely on the S&P 500 advancing, and anything that has anything to do with the stability of the bond market. I think to buy anything fixed income oriented now in the bond market is just absolute insanity. I think that unless you're going to go way low credits, the yields you're going to get are just not worth the risk. So we're using a lot of alternative strategies. There's strategies that have nothing to do with the stock market per se, and that's where I'm comfortable right now.
Well, we could talk about this all day long, but unfortunately, that's all the time we have today. Thanks so much to all three of you for being with us. I enjoyed the conversation.
Thank you.